It's China's Lehman Brothers moment. I'll show you why I'm afraid this could kick off a global banking crisis. Now, let's turn to Bloomberg, where he picked today's story by the headline. As Evergrande's debt hits $45 billion with restructuring now completely ruled out. And I want to understand why this is so important, why this is China's Lehman Brothers moment. Because when you go back to the global financial crisis, what happened? Was it all about mortgages? No, it was about the fact that homes were not worth the value that the mortgages were set at. And that was the issue, because what caused Lehman Brothers and Bear Stearns to blow up? It was price discovery, when the world found out that the assets they were holding on their books were worth far less. And next thing you know, everything imploded. And that's the issue we're facing here in China, because when you go to restructuring, well, you have a chance to pretend and extend the loan. That didn't work. The next phase is liquidation, and that's where you find out things are worth far less, which could kick off a global banking crisis. It's been a monumental task, as Evergrande comprises 3,000 legal entities in multiple jurisdictions, as well as about 1,300 projects under development in more than 280 cities. And it's those 1,300 projects that we know are probably not worth the price that Evergrande is saying they are. And that's going to be a problem, because it's going to cascade all through the Chinese property sector. And what we know is the banks are over leveraged. They've extended a lot of loans to these developers, and next thing you know, they're going to be forced to find out what price discovery means when you hold a lot of debt against assets that are worth far less. And China's Evergrande first defaulted back in 2021, sending shockwaves to the nation's real estate market that is still seeking to recover. In fact, there's no signs it's going to recover. And we start to get to the real issues here. The Chinese economy is slowing. The banks, again, were forced by Beijing to lend to these property developers to keep them from going insolvent. And then Beijing turned around and said, look, we're going to stimulate, but it didn't work. So they kept doing it over and over. And every time we said, look, this isn't going to happen. It's not going to work, because prices keep falling. And now the risk is Evergrande's going to go into liquidation, because those who were holding that debt, well, they wanted to get paid. So they went to court. Restructuring didn't work. Now the problem is, once those assets hit liquidation and they're sold, it's going to reprice the entire industry. And for the banks holding that debt, well, what you're facing is their Lehman Brothers moment. There were also 3,000 projects under the Hong Kong-listed property management operation Evergrande Property Services. And creditors are especially paying close attention to the handling of this arm, since it, quote, represents a very substantial potential source of value, and are being, quote, given the highest priority in terms of attention. So can you imagine when 3,000 properties hit the market to get sold, to liquidated, to provide money for the creditors? Can you only imagine that prices are going to go down even more? And again, at some point, the banks are going to be forced to have to deal with the fact that the debt they hold against these property developers is worth far less. And when that happens, what you see with banks is they go insolvent. You start to have liquidity issues, and then governments come in and they start pumping massive amounts of money into the financial system, and for some reason it starts disappearing overnight. It's not because people are taking it, it's because there's a giant vacuum in the financial system. And we've already seen Beijing pump the system with money. But if this liquidation happens, watch out. They're going to have to pump a ton of money into it. And the risk is this debt isn't just held by Chinese banks. It's held by investors all over the world. Several other Chinese developers face similar delisting risks, as Evergrande was now delisted. They include mid-sized builders such as Modern Land, which has been suspended for 16 months, and Dexon China Holdings, which received a liquidation order in June of last year. So here's the issue again. If one company goes into liquidation, next thing you know, you're going to have price discovery. And then all of a sudden, all these other companies who are overvaluing their assets, they're not going to be able to pay on their debt. And next thing you know, they're going to go into delinquency and into default. They're going to go to court, and what's going to happen? You're going to find even more liquidation. You're going to have even more properties dumped into an illiquid market where there's no demand, and next thing you know, there's no bottom in sight where prices could go, and that's going to spiral right into the banking system. And what we're facing now is China's Lehman Brothers 2.0. You can see it happening right now in real time. But just because Chinese property developers are facing liquidation doesn't mean your trading account has to go down with it. Let's take a look at that trade we put onto our CTA Timer Pro subscribers back on the 5th. We told them to buy GDX at the open, and on the 11th, they were stopped out for a 3.63% gain. Now, if you want to trade against the machines like we do, all you have to do is grab those links in the description below, use a coupon code for your free 30-day trial, and stay tuned to the end of the show because our groundbreaking meta strategy is dropping some amazing trades. And we've got some further improvements that are going to change the way people trade. Again, stay tuned to the end of the show for more information. Now, let's turn to the U.S. data because I said in yesterday's show this was going to rattle the markets. Well, it sent them higher. But as you're about to see, the risk for the U.S. economy is now squarely to the downside. As U.S. core CPI picks up on services, goods inflation more subdued. Now, what are we seeing at the factory sector? We're seeing manufacturers absorb as much of this tariff increase as they can. But service providers are taking a different path. They're trying to raise prices. But what have we seen each and every time they raise prices? Consumers reject them. We've seen this happen all over the world. Let's take a look at the CPI report because it's very interesting. As we take a look at food, there was virtually no change. In fact, when we look at it, the big increase came from fuel oil. Now, when you strip out food and energy, well, that's where the inflation was. You can see it in the services sector. Used car prices were up, transportation services, medical services, they were both up big, driving the services, less energy, up 0.4%. What this means is we actually saw the core go up to 3.1%. Meanwhile, the broad CPI unchanged around 2.7%. So we're definitely seeing signs of disinflation here, in some cases a little bit of deflation, but the services side has upward pressure on prices. Now, this is a major problem for the economy because a lot of service providers think at some level they're going to be able to pass this through. But what have we been seeing in a recent earnings report? They're starting to wake up to the reality, raise prices, foot traffic goes down. And inflation was broadly in line with expectations as tariffs continue to be largely absorbed within profit margins. This gives Fed the room to respond to the weaker jobs backdrop and cuts interest rates from September. Well, the first issue is all about the stock market because it rallied big today on the idea that the Fed was going to cut rates. And remember, I said that in yesterday's show. If there's any hint in the CPI that the Fed could cut, stocks are going to rally because everybody thinks that causes liquidity to get injected into the financial system. It creates this belief now that we're going to experience a soft landing. But the reality here is if companies are absorbing these tariffs, well, what does it mean for their profit margin? Well, it means it's headed lower. Let's take a look at this chart of corporate profits after tax against the NASDAQ composite. That's shown in red. And what you can see in history is when profits are going down and stocks are rallying, well, what happens? You go right into a bear market, and you can see that repeat throughout history. And right now, once again, investors are chasing stock prices higher. At the same time, we're seeing more and more companies absorb higher prices. It means their profits are going to go down, and that at some point is going to affect their stock price in a major way. The reacceleration of services costs after months of more subdued points underscores the lingering difficulties in taming inflation. Economists and policymakers have been largely concerned about goods prices given President Donald Trump's sweeping tariffs, but consumer demand risks augmenting services inflation. And this is exactly what I've been warning about is, yes, you can see people raise their prices all they want. The problem is, if you raise prices and nobody buys it, prices are going to come right back down. And that's what you're hearing from retailers and wholesalers and manufacturers. They want to raise their prices. They want to increase their margins. They're concerned that they're absorbing so much of this price increase. The reality is consumers can't afford it, and that's the real issue here. Let's take a look at the Consumer Price Index in blue against average weekly hours of production and non-supervisory employees in red. And you get a very clear sign of what happens here is price pressure goes up throughout history, but if hours are going down, and that means paychecks are shrinking relative to inflation, well, what happens? Demand goes down, and you see inflation turn into disinflation. And sometimes, like we had during the global financial crisis, inflation turns into outright deflation. And that's the risk we're facing right now. Everybody thinks inflation is going to go higher. Service providers want to pass on these higher costs, but consumers can't afford them. And that's the issue at hand, is no matter what anyone does with price pressure, every time they increase it, consumers back off. And again, it all comes down to the fact that their paychecks aren't keeping pace. And central bankers also pay close attention to wage growth because it can help inform expectations for consumer spending, the main engine of the economy. In a separate report Tuesday that combines inflation figures with recent wage data showed that real average hourly earnings climbed 1.2% in July from the year before. And again, you add into the fact that the CPI was a little softer than people expected and that there was wage growth, and you can see why stocks took off, because what you're seeing in the stock market is the belief that consumers can afford higher prices. But there's an issue here because you typically see wage growth even during recessions. That's because those who are fortunate enough to keep their job continue to get pay raises. But when you blend that with average weekly hours, you get a completely different perspective, and that's called total income. Let's take a look at this chart here of average hourly earnings multiplied by average weekly hours of production and non-supervisory employees, and you can see going back into every recession, it was led by a deceleration in incomes. And right now, despite the fact that Wall Street's excited that average hourly earnings are up, the reality is paychecks and total income, they're not up at all. So if service providers and other companies push to raise prices, consumers are going to balk at them even more. And that's what the bond market was telling us, because while stocks were up today, the bond market was giving us a much different picture about the U.S. economy. As U.S. short-term yields fall as inflation data boosts rate cut bets. And that's what the news is interpreting this. They're seeing that, well, short-term yields are going down, so it must be a sign that the Fed's going to cut rates. But it's really actually a sign that financial conditions are tightening. And my friends, that's not bullish for stocks over the long term. It feels like the market was worried about a worse number, and that could have put the brakes on Fed rate cuts. And again, that's what this is all about. If the Fed will just cut rates, they'll inject liquidity into the economy, and they'll cement the soft landing, and that means stocks are going to soar. But the real issue again at hand, when rates on the front end of the curve go down, it means financial conditions are tightening. But just because they're falling, does that mean the Fed's going to cut in next month? Well, maybe. Let's take a look at this chart of the funds rate against two-year treasuries, and you can see in every cycle, a decline in two-year treasuries leads the federal funds rate each and every time. But right now, two-year yields aren't plummeting, and that's the problem because it doesn't actually fully support that the Fed should do a big cut. Maybe a quarter basis point cut, but again, if you think that's going to change the needle of the U.S. economy, well, it's not, and that's the problem, because what the bond market is telling us is things are getting worse. But yet again, equity investors here very excited. Let's take a look at the NASDAQ 100 against two-year treasuries, because when you see a collapse in two-year yields, it usually means we're headed into a bear market. Right now, we see exact opposite happening. Two-year yields are going down. NASDAQ's going up. At some point, either yields need to rise here to validate the economy that the market's telling us we have, or stock prices need to come down and match right alongside what's going on in the bond market, which is telling us we're headed right into a recession. And we're getting some validation of that from small businesses, but on the headline, well, optimism in the small businesses survey rise to a 5-month high on the economy. But what really changed about the economy? Well, nothing from a consumer perspective, but everything from a government perspective. And that 36% of owners expect better business conditions, now at 14 points from a month earlier and the most this year. And that 16% said now it's a good time to expand their business, the largest share since January. So the question is, what changed for small businesses? Was it a huge surge in demand? Did people come out and spend big last month that we haven't seen in the retail sales report yet? Or no, what it really was the tax cut. That was the biggest issue small businesses were facing. They were worried about taxes. They got the tax cut. And what this means now is that they can actually absorb some of this tariff increase, and that's what they know they have to do. The group's uncertainty index, meanwhile, rose by the most since the start of the year. At the same time, the survey showed price pressures eased. A net share of small businesses that raised prices dropped to 24%, the lowest since January. And fewer firms also expect to boost prices in the next 3 months. And the reason they don't expect to raise prices? Because they know they can't. They've already seen what happens. They raise prices, demand goes down. And that's why they wanted the tax bill so bad, because it gives them the opportunity to absorb some of these tariffs, because they know they're not in a position to raise prices. And the evidence is going to be very clear as we get the upcoming retail sales report. We already know it's not going to be good, and the optimism from retailers had nothing to do with sales, all about taxes. Let's take a look at this chart of real retail sales in blue against average weekly hours of production and non-supervisory employees in red. And what do we see in every cycle? As weekly hours drop, retail sales drop. And that's the issue we're facing right now. And you can see that we talked about that total income number. It hasn't moved. The needle hasn't moved. So that means any increases in prices, consumers can't afford them. And that means they spend less. And when they spend less, well, next thing you know, retailers get stuck with inventory. They start to be forced to cut prices, and then we're headed right into recession. But as we zoom back out to China, the real risk here is we're facing a Lehman Brothers moment that could cause a mass repricing of all Chinese real estate, and that could flow right through the global banking system. And next thing you know, out of fear, that would cause U.S. consumers to cut their spending in a major way. At the same time, we're seeing a huge inventory build, suggesting that if consumers here in the U.S. pull back, we're headed right into recession right alongside China. But even if the economy blows up, it doesn't mean your trading account has to go with it. Let's talk about the trade on GTX. I came to our CTA Timer Pro subscribers. Now, each and every day, we look at machine positioning across the broad equity, bond, currency, and commodity markets, and we look to see when the machines are buying, particularly out of a major short position, and that triggers on a report. Now, we've even backtested, so we know which of our signals have a high probability of generating a positive return. And that shows up on the first page of our report under the hot list, and then you get the machine positioning of all across the different sectors. Now, you also get for free our Metre strategy, and this is an advanced trading system that combines 9 professional trading strategies into a single intelligent signal generator, providing 31 times more frequent buy signals than the individual strategies on their own. Now, we incorporate the Bravo 9, Turtle Trading, 200-day moving cross, golden cross, trend pullback, RSI divergence, 520 EMA cross, channel trading, and Fibonacci retracement. We have a target hold period optimized for swing trading for 2 to 15 days. We're generating 155 signals per year, and we have a 55% success rate with fast profit taking. My friends, we're changing the way people swing trade, and right now you can get in on that at no additional charge. All you have to do is grab those links in the description below, use a coupon code for your free 30-day trial, because in addition, you get the daily report, you get all the signals, you get the Metre signals, you get stop loss levels, a full tracking of all open trades and returns, and a weekly update. And again, grab those links in the description below, use those coupon codes for your free 30-day trial. And with that, I'm Steve Edmeter. Thanks for watching. Thanks for being fans. Bye now.